Hello everyone, my name is Greg Olney. I'm here to teach you about how to save for the future. In this webisode, we'll be covering 5 main topics that build on each other. How money grows, time frames for investing, what vehicles to use, market fluctuations, and retirement planning. So get excited and try to enjoy yourself along the way. Before we jump into the different ways to invest, we have to first look at how money grows over time. A simple way to understand this is to look at the Rule of 72. The Rule of 72 tells us how long it takes for your money to double. In this example, you see the column on the left. How long will it take for the $10,000 to double? In order to find this out, we need to use the Rule of 72. In this case, you take the number 72 and divide it by the interest rate of 4. 72 divided by 4 equals 18 years. You can typically see this 4% rate of return when you have your money with a bank or cash value life insurance policy. In the middle column, we see a 6% rate of return. In this example, we now know that it takes only 12 years for your money to double. Why? Because 72 divided by 6 equals 12 years. You can typically earn 6% in bonds or short-term securities. Finally, the column on the right shows a 12% rate of return. In this example, it only takes 6 years instead of 18 years for $10,000 to become $20,000. That's a huge improvement. As you can see on the right, the 12% had 6 doubling periods within 36 years. Albert Einstein once said something about this. The most powerful force in all the universe is the power of compound interest. Thanks, Albert. You couldn't agree more. One example of this rate of return would be in a well-diversified mutual fund. Here's what the majority of people don't know. Money typically grows at the same rate. The challenge is that most Americans are not getting that full rate. But when we put money in the bank is the one getting that full 12%. So if money is growing at 12%, $640,000 will be made over this example's 36-year time period. So what happens if you have your money in the bank or in a cash value life insurance policy? You get $40,000 while the financial institution gets the remaining $600,000. No! Because you loan them your money. A very good rule of thumb to live by is never let anyone else make more money on your money than you do. One shortcoming of this example is that most people don't think that 12% is very realistic. I'll address this issue shortly. Now you know at what rate money can grow, as well as the importance of the Rule of 72. Now we'll discuss how to invest your money depending on the time frame in which you'll need it. Here are 3 fundamental accounts that must be addressed when investing for your future. Each account represents a time frame. The first account is your emergency account. This account represents funds that you'll need within the next 0 to 3 years. You can't afford to put money away for Christmas or for your taxes and have it lose value due to a market upset. This account should be liquid, meaning it's easily accessible and convertible to cash. It's designed to keep up with inflation and deter you from using your credit card due to unforeseen circumstances, such as a flat tire. This account is usually comprised of a money market fund. This fund should have a check writing privilege. As a rule of thumb, 25% of your savings should go into this account. The rate of return is typically anywhere from 0.5% to 5%. The next account is your short-term account. This account represents funds that you'll need within the next 3 to 5 years. This account is for planned future purchases, such as paying cash for a vehicle or a down payment on a home. These funds also allow for security in case of potential unemployment. This account should have a decent rate of return and should be comprised of a conservative, less risky, widely diversified, balanced fund. This will allow for the less fluctuation and greater security. 25% of your savings should fund this account. The rate of return typically averages about 10%. The third account is your wealth building account. This account represents funds that you will not need for a minimum of 7 to 10 years or longer. This account is usually used for retirement. Ideally, enough money should be accumulated to where you could live off the interest without ever tapping into the principal. 50% of your savings should fund this account. During the accumulation period, you can expect an average rate of return of 12% or more. Keep in mind, the greater the return, the higher the volatility of the account. The higher the fluctuation of the account, the longer the time frame you need to allow your investment to grow. Now you understand your three fundamental accounts. But which vehicle should I use to invest my money for retirement? There are three basic ways to invest your money. The first is with a bank or credit union. Here you can expect to see a rate of return anywhere from 1% to 4%. Unfortunately, inflation is about 3 to 4% right now, so your real rate of return at best is 0%. This means you are never getting ahead. So if you're saving for retirement and you're eating hamburgers today, in retirement you still will only be eating hamburgers. I'm here to teach you how to be eating hamburgers today and have your money work hard enough for you so that when you're ready to retire, you can be eating steak. After learning the rule of 72, we understand it is less likely to achieve this through a bank. The next method we can invest is with stocks. The challenge with stocks is that they are a bang or a bust. Some may do amazing, some may crash and burn. One analogy would be Enron. Back in the day, it was an excellent stock. It was in high demand. But what happened next? The company fell to its knees and many investors lost everything. A more current analogy would be AIG or GM. These are very credible stocks to most investors. But after the company crashed, there were many unhappy stockholders who went belly up. The problem with stocks is that they're not diversified. All your eggs are in one basket. Also, if you use this approach, the research alone could be very time-consuming. The standard rule of thumb is to never invest more than 10% of your savings in stocks. This includes company matching in a 401k, unless you're already wealthy or are already widely diversified. The third way to invest is mutual funds. The advantage of mutual funds is that instead of investing in a few companies like Enron, AIG, or GM, it is diversified. So when you put money into a mutual fund, they are going to spread it out between a whole bunch of companies, maybe as many as 200 or 300. If one of those companies goes belly up, you still have plenty of other companies left to protect your investment. Because of this, there has never been a failure of a mutual fund since it started in 1924. Growth mutual funds also averaged about 12%. So this is where we get the 12% that I was talking about earlier. They are also professionally managed, so no time-consuming research. They also have an established track record. Here, if you're investing in mutual funds and you're getting a 12% rate of return, once again, you may be eating hamburgers today, but down the road, even if you're not working, your money is working hard enough for you so you can eventually be eating steak instead of hamburgers. By now you should have noticed a commonality of mutual funds earning 12% since 1924. But how are you going to feel when you invest your money and your investment goes down 20%? You would think I was a liar because I said you could make 12%. Well, let's look at how you could go about getting this rate of return. We need to have time on our side. No investment guru has a crystal ball that tells them exactly what the market is going to do. But what everyone can determine is that historically, over time, the market has accomplished 12%. Here's an example of an actual mutual fund during the 10-year time frame from 1995 to 2004. There are some pretty good years here. There are also a few bad ones. So if you started investing toward the end of 2000 and the next 2 years did a combined negative 22%, you probably would be unhappy. Remember that wealth building account that we spoke about earlier, what was the time frame for that account? It was 7 to 10 years. Although 2001 and 2002 were bad, in the big picture, they're not going to be as impactful as the rest of the years surrounding them. Let's now look at this broad picture. After all the expenses were taken out, this fund earned 11.97%. So there is that 12% rate of return, even though we had a few bad years because it averaged out. The important thing to know is when the bad years happen, that the good years are still to come. I hope you've enjoyed this presentation of how to save for your future. If you fell asleep, you'll wake up at the snap of my fingers. Welcome back. To learn about similar or related financial topics, please stay tuned. And please remember to rate and subscribe below, or the kitty gets it. Just kidding. If you would like to comment or have a subject covered, please write or email below. For help concerning all your financial goals, you can reach my personal friend and consultant, Thomas Johnson, at 877-815-1907. Happy investing.